Bonds right now are on track to have one of their worst years ever in history. So why should you care? Well, bonds are the second biggest asset class globally after real estate and ahead of stocks. What happens in bond markets can affect everything. So let's talk about bonds today. What are they? Why they matter? What this record bad year means for, well, bonds as well as the wider markets and your portfolio. So first, we need to discuss what the heck are bonds anyway. Boring old bonds, an asset class worth over $100 trillion. It usually moves with glacial speed, but in 2022 is acting more like the Titanic after hitting an iceberg. But let's start at the beginning. What are bonds? Well, quite simply put, bonds are an IOU between a lender and a borrower. It's a slice of debt issued off by governments, corporations, banks, and that's sold off to investors. Now, this debt is created when public and private organizations need to borrow some money to finance, new infrastructure projects, maintain operations, or maybe refinance existing debts. Bonds are also known as fixed income investments, as you buy a bond for a fixed period of time in exchange for lending out your money. Of course, then investors want to get compensated in the form of interest. That's known as a bond yield. Now, at the end of that fixed period of time, investors will be hoping, of course, to get their original investment back, plus whatever interest was promised. Now, there are four main types of bonds. First, there's government bonds. This is the most popular, the most common kind. A government bond is a debt security issued by a government to support government spending and different other obligations. Now, for example, in the United States, these are known more commonly as treasury bills, and they are a type of sovereign debt. Then there's municipal bonds. Now, these are issued out by a government organization, maybe a district within the government, like a city, for example. This is done to raise funds for public sector projects. Now, this can include stuff like construction of roads, construction of highways, hospitals, schools, railroads, all that kind of stuff. Then we have corporate bonds. These are, of course, issued by companies. So when a business wants to raise capital without going to the bank for a loan, this is what they do. Now, this can be because the bond market maybe is offering them more favorable terms. For example, they're going to pay lower interest rates by going to the bond market instead of the bank. And finally, of course, you have mortgage bonds. So these are bonds secured by mortgages or a basket of mortgages on real estate assets. These are also known as mortgage-backed securities. These are, of course, what led to the 2008 financial crisis. Now, bonds can vary in length, with short-term bonds lasting for just a few months or a few years, and of course, long-term bonds can be up to 10, 20, or even 30 years until they reach their bond maturity. Now, let's get into what the heck bonds are doing in 2022, because this is the real story. I want you to understand what bonds are, but now let's get to the real story. So the US bond market is on track to have its worst year in a very, very long time, with a loss of 13.8%, which if you were holding Bitcoin that is down 75%, you might be thinking, hey, only 13.8% doesn't sound too bad, but it is pretty bad because this is a massive asset class. Now, why is this happening? Well, because we've seen interest rates rise the fastest in 40 freaking years. When interest rates rise, bond yields also increase. Now, whilst that sounds great for investors, there's one thing you have to know about bonds. Bond prices are inversely correlated with interest rates. So when interest rates go up and the bond yield goes up, well, the bond value goes down. Now, bonds don't get as much attention as the stock market because, let's face it, bonds aren't super exciting or super sexy, but they should be getting attention. They should be paid attention to because the bond market, also known as the credit or the debt market, it is the base layer of the financial system. The bond market is also much bigger than the stock market. It's more than tripled in size in just the last 15 years. The global total, well over $100 trillion. $40 trillion of that just in US Treasury bills. Now, that's compared to just $20 trillion, by the way, in US stock market, so it's twice the size. And almost $700 billion in bonds are traded every single day compared to just $200 billion traded per day in stocks. So, kind of a big deal. So when interest rates go up too much, too soon, we start seeing a situation where liquidity begins to dry up within the financial system, and more specifically within the bond market. So it's now reached a situation where it's become too expensive to borrow money. Assets start decreasing so much in value that investors then have to sell off their assets to raise cash, this has the dramatic carry-on effect throughout the market. For example, retirement funds are largely made up of government bonds, because it's supposed to be safe, right? So in higher interest rate environments, we start getting a situation where there's added pressure and stress on these retirement funds to generate the same returns needed to take care of retirees later on. This is exactly what has just happened in the United Kingdom, leaving retirement funds deeply exposed to the bond markets and basically stuck in a situation where they're forced into a downward spiral. The UK was unprepared for this situation, for a loss of international confidence that happened after announcing its unfunded tax cuts and increased spending plan, which resulted in the previous prime minister having to resign, new prime minister's in. And this caused a massive sell-off as well in the UK bond markets, pushing yields through the roof and forcing liquidations throughout pension funds, man. UK pension funds were on the verge of disaster before the Bank of England had to step in to intervene. Now in the UK, there's a situation where pension funds are highly leveraged, so they need to make enough money to pay for those retirees on what's known as a final salary pension scheme. So a final salary pension scheme is a sort of some kind of a guaranteed deal they have in the UK where you're gonna be paid the same annual salary in retirement as you had back when you were working. So the Bank of England, yeah, it was a mess. They had to come in, they were forced to bail out the banks, the pension funds, step in and start buying UK bonds again. But that only pushed yields up higher, decreasing bonds further. And once that downward spiral starts in the bond market, it's hard to stop. As a result, UK bonds, also known as gilts, have lost an average of 52.3% since December 2021. Yikes! And when bonds are out here dropping like shitcoins, you know we've got problems in the economy. That's an entire decade of gains wiped out in less than a year. Heck, the longest maturity UK government bond has actually fallen even more than Bitcoin during this bear market. It's down by 78%. And they say Bitcoin's too volatile, man. Come on. Now, before I tell you about what happened to all of the bond buyers, where are the people needing to buy these bonds, and if bonds, of course, are a good investment or not, I just wanted to let you know about my weekly cryptocurrency investor newsletter. It's called Wealth Mastery. Every single issue is jam-packed with alpha on altcoins, airdrops, NFTs, step-by-step tutorials for DeFi protocols, market analysis, and more. Join our 50,000 weekly readers by signing up for free using the link in the description. So, where the heck are the buyers? Where are the people who usually buy the bonds? Well, of course, the United States is in the driver's seat when it comes to raising interest rates. Central banks all over the world, they're having to increase their interest rates too because the US keeps pushing the dollar up. They need to limit the damage to their own currencies, their own bond markets, so central banks around the world are being forced to respond to this. The rest of the world right now is getting crushed by the US dollar, and countries are currently being forced to sell their US Treasury bonds back into their own currencies in order to give those currencies a boost. We're seeing this happen already as US Treasury bonds are increasingly being sold off worldwide in 2022. In fact, the total US Treasury holdings worldwide are at their lowest level since November 2018. We're seeing Japan, China, the United Kingdom. They were the top holders of US Treasuries back in July 2022. And once upon a time, they were actually buying up as many US Treasuries as they could get their hands on. But now, these countries can't wait to get rid of their US Treasury bonds, which means that the biggest players in the $23.7 trillion US Treasury bond market are trimming their holdings and fast. Countries, of course, leading the sell-off, not just the UK, we see around Asia, Japan, China, South Korea, they're all getting out of US Treasuries due to the drop in their respective currencies. Happening all over the world though. Central banks are scrambling to shore up their own currencies in the face of all the madness going on in the global macro markets. Now we finally reached the point in the video where I'm going to answer the question for you, are bonds a good investment? Well, I am personally not a bond investor, but bonds are typically seen as a low risk, but low reward investment. But if 2022 is anything to go by, if it's proven anything to us, bonds are anything but risk free. The advantage, of course, of bonds and why people usually want to invest in them is that, well, they are income paying investments. And of course, you should get all your money back if you hold that bond to maturity. You can also profit at the end if the bond is valued at a higher price than what you paid for it when you bought it. Now, the disadvantages, of course, of bonds are that, well, you do get lower on average returns than stocks, bond returns have been pretty pitiful for a very long time. They're only soaring now because of the interest rate hikes. The issuer can also default on the bond if they run out of money, more likely to apply to corporations versus countries, but still can happen. Bond yields and bond prices, though, tend to move in the opposite direction to each other, so you do have to decide basically what you're willing to compromise on, what kind of risks you're willing to take, because bonds are not risk-free. Now, generally, government bonds, they're seen as the safest form of bonds, given, of course, that there's a government backing up those bonds. Governments are the least likely entities to, well, go bankrupt. Corporate bonds are seen as a riskier bet versus a government bond, and therefore they tend to attract higher interest rate returns for investors. Now, it's generally recommended as you get older to move more and more of your investment portfolio over in the bonds. Preserve your capital, right? That's, of course, if you believe that fiat currency is not a Ponzi scheme, which, you know, kind of is. The most important thing to understand, too, is that bonds are an IOU, with you being the lender. So you must ask yourself whether you are confident that the borrower will have the funds to repay you at the end when it's time for them to actually pay up. Now, there's an increasingly less certain yes to that answer, right? In a world so full of dysfunction. Personally, I'm going to stick to my Bitcoin. Thank you very much, bonds, but not interested. But anyway, you'll let me know what you think about all that down below in the comments section. Subscribe now to the channel. See you next time.